let's move on. And our first question is from Azharuddin from Qatar. Hi, good evening. How are you? Do I have Azharuddin on the call with me?
Good afternoon.
Hi, how are you doing?
Yeah, I'm good. How are you, ma'am?
I'm doing good, thank you. Okay, so you want to invest for 15 to 20 years for your daughter and son's education, their marriage and your retirement. And you are investing in Parag Parikh Flexi Cap, PGIM India Flexi Cap, SBI Multi Cap, SBI Contra, Quant Small Cap, PGIM India Mid Cap, Quant Small Cap, Canara Robeco Small Cap, Tata Small Cap, right?
Yes, ma'am.
Okay.
I already started, ma'am, in March 2023.
Got it. What's the corpus that you're looking at?
2.5 crore,
After 20 years.
15 to 20 years, because I don't need money now.
Mm-hmm.
After 15 to 20 years, I need money. So in the long period of time,
So you have your kids' education, you have their marriage, and then you have your retirement. And 2.5 crore will be enough for all of these three goals.
for now, I'm just starting with one.
Mm-hmm.
I can increase the amount.
Mm-hmm.
For now, I just starting, so I just see how it's going on. Then
Sure.
I'll.
Okay, you are
I
very.
have also,
Okay,
actually, I have also. Sorry.
Yeah, please
Okay.
go on. Yeah.
Actually, I have also Sukanya Samriddhi Yojana for my daughter.
Okay. Got it. Anything
That's
else?
it. And no, that's only. Yeah.
Okay, so one thing very good that you could figure out a portfolio overlap in PGIM Flexi Cap and PGIM Mid Cap, but then don't you think you have too many small cap in your portfolio? Is that intentionally done?
Small cap and mid cap generate good return,
Okay.
and that's why I'm taking that risk. Actually, I don't need money now, so I kept in mid cap and small cap so that I can generate maybe 3 crores if I get good returns in mid cap and small cap.
Got it. All right, Kaustubh, over to you. Anything else you want to ask him?
No, I think we have all the details
Sure.
that I need. And I think, firstly, I'd just like to congratulate Azharuddin that I think he's thought through a lot of these decisions, obviously, and, starting to plan early, and he's got his goals in mind, which is great. And he's also done some analysis in terms of, portfolio overlap, which I'll talk about a bit later in my answer. But I think a few observations and thoughts, right? So I think when I think about the current SIP that he's doing is about 27,000 across all of these funds. And like you rightly pointed out, Kavita, there is a significant quantum of small cap and mid cap, and he also acknowledged that he can take on risk. But I just want to make a few points around that. So one is, if I just do the math and I think about 27,000 of SIP as of today, and with an investment horizon of about 15 to 20 years, even if we take simple basic assumptions that the SIP amount is stepped up by 10%, which is I think a very reasonable assumption or expectation to have, that you step that SIP up every year by 10%, and even if you take a conservative return estimate of 10% of the portfolio, I think the goal will be very easily achieved. So the point that I'm making is, while small and mid caps are definitely, there's no discussion about it, great wealth generators over the long term, but I think it's also important to acknowledge that when you think about any portfolio construct, the core of any portfolio should still be on the more, while equities, but still leaning towards large caps. You can definitely take on a significant amount, maybe 40, 45, 50% of small and mid caps across that. But currently it stands, I think, in excess of 70%. And however higher risk taking ability, I think, we should look to peg that expectation down slightly, simply because, we have seen how sharp the drawdowns on small and mid caps can be, especially on small caps. In the past, we've seen 40, 50% or even more during the GFC. So I think just we need to be a little cognizant of those kind of events, and build a more robust portfolio by switching out maybe about 20% to a more, flexi or large cap focused sort of portfolio. That's one observation that I definitely want Azharuddin to consider. I've already spoken about the SIP step up, and he also spoke about it that he can increase his SIP amounts. I would definitely urge him to do that as time goes on, maybe 10, 15, 20% as his finances allow him. And third, and the most important thing, because we're looking for a goal which is non-negotiable for obviously for his family in terms of education and marriage. So we want to have good certainty that the corpus that he desires to have is available to him during that time. So we've always spoken about the concept of glide path investing. So right now it's 20 years away, so we can have a very equity heavy portfolio, no doubt about it. But as we get along the journey, so when you're entering maybe in 2033 or 2035, as you're only like 7 years away from your goal, we would want you to start cutting your equity exposure. Maybe if you're at 90% today, bring it down to 75, 70, and at the end, you should probably be, maybe about 40, 50% equity towards the end of your goal. Because the last thing you want to do is have an event risk embedded into your portfolio value. So you might have very easily achieved your goal, but if there is a dramatic event 6 months before, you want this corpus and markets correct 20, 30%, as we've seen even during COVID crisis. Your portfolio value can erode probably below your core level. So I think that's the other factor that needs to be built into the portfolio planning. When a glide path of reducing equity exposure and moving to fixed income closer as we get closer to the goal date. So otherwise, I think broadly, the portfolio construct looks good. Just reduce the small and mid cap exposure, like I said, and I think he'll be able to achieve his goals very, very easily and probably have some money extra on his side additionally for his retirement.
On his behalf, the kind of the funds that you've recommended, he doesn't need to add any more fund. Even if he plans to step up his SIP, the fund mix is the same and the number of funds remain the same.
Yeah, that's okay. I mean,
Sure. Okay.
I wouldn't be too fixated on that, but I would maybe bring in like either a flexi or a large cap fund to reduce the small cap exposure. That he already has a multi and a flexi fund. Maybe he can just additionally add to those rather than introducing new funds into his bouquet.
All right, let's move on. And we have Vishnu from Bangalore. Hi, Vishnu. Good evening.
Good evening.
All right, you want to have a corpus of 5 crores in 10 years and you have ABSL Frontline, you have Axis Blue Chip, Axis Mid Cap, Axis Small Cap, HDFC Mid Cap Opportunity, ICICI Blue Chip, Parag Parikh Flexi Cap, Motilal Oswal Nasdaq 100, Edelweiss Greater China, you have PGIM Global Opportunity, ICICI Value Discovery, Murray Emerging Equity, and you want to know if your goal can be achieved with this fund mix. Got it? Is there anything else that you want to add?
Yeah, actually, I accumulated this over the past 6 to 7 years. Depending on performance, I paused on some of the funds but continued SIP in few others. Currently, mainly, I'm doing SIP in Paribas Flexi Cap. I'm doing in ICICI Blue Chip, HDFC Mid Cap, Axis Mid Cap, Axis Small Cap, these and ICICI Blue Chip. These are the key funds I'm doing the SIP, and my current corpus is about 2.2 crores. Just want to ensure that in the next 10 years, I'm able to see a corpus of at least around 5 crores or so. Is it fair to continue in this model, or should I move some of these into debt funds? So I'm just looking at some advisory around that.
All right. Kaustubh, can you reduce the number of funds?
Yeah, so I just want to understand from Vishnu, so what is the current SIP, monthly SIP that he's doing in addition to the funds that he shared in terms of just a monthly number?
Approximately, I'm doing around 1.1 lakh.
Okay, 1.1. Okay. Sure. So I think firstly, when I just look across the funds, in terms of individual funds, I think it's good because what I'm seeing is a good mix of a couple of things, a good mix of capitalizations, right? Large, mid, and smalls. And I'm also seeing different styles come in, which is great. So, you have your Axis group of funds, which are more growth and quality oriented. You also have, value discovery that's thrown in, which is more value tilted. And then you have your Mirais and the Aditya Birlas, which are more GARP sort of. So I think in terms of overall construct, it's good. I don't think there is a necessary need to reduce the number of funds, to be honest, because I think all of these are pretty well managed funds. And again, I think limited over in the sense. So there's good diversification, like I alluded to, coming in from there. When I look at the math of the portfolio, so obviously you're sitting at about 2.2 crores of corpus right now, doing 1.1 lakhs of SIPs every month, and wanting to grow to about 5 crores in 10 years. I think it's easily achievable. Even if you just draw a straight line today, obviously that's not what we recommend, but just for hypothetical sake, at 10%, on the current corpus, without even considering the SIP, you would be close to that achievement number. But the one tweak, obviously, which I spoke to the earlier viewer also about, is that because you want to kind of proof yourself from, risk-proof yourself from the event risk that can come from a asset class like equities, and you're 10 years away, maybe about 5 years from now, you should start, reducing, cutting your equity exposure. So for that is where your 1.1 lakhs are also going to add up, right? So right now, your return expectations obviously would look higher because that's all equity. And you could make it just purely on the equity exposure you have, but the 1.1 lakh they're adding today is going to add that corpus, so that even if we lower the return expectations, because 5 years from now you'd probably want to be at 70-30 and then slowly gradually bring it down every year, once you're at 10 years, probably at 40% equities only. And I would urge you to do the math yourself, so that you can tweak the numbers and see what works best for you. But that's certainly something. Following that glide path to asset allocation would definitely help you achieve that 5 crore goal very easily, with a great amount of probability, and probably exceeding that by a fair margin, given that you're already adding that 1.1 lakhs every month in an SIP, and continue doing so, and keep adding to that value. Step that up each year as you go along. Just that pivot to asset allocation maybe 5 years from now, and keep pulling out from equity gradually into fixed income, in about 2028 onwards.
Right, Vishnu. Thank you so much for sending us your query. We move on, and we have Shama Prasad Malik on the line with us. Good evening.
Good evening.
How are you, sir?
I'm fine.
All right. Thank you so much for watching the show regularly.
Yeah.
Okay, so you want to know whether ICICI Pru Asset Allocator Fund Direct Plan is now considered as a debt fund, and whether the changes would impact you. Is there anything else you want to add to your question?
I don't want to. I just want to say I'm a retired man, so mostly my mutual fund portfolio of around 1.7 CR is mostly on short-term fund, banking PSU fund. I do it directly, and all other equity funds are passive. Now, that this is a typical fund of fund, I do not know whether adding some, because it's a good fund I have observed since last couple of years, adding is going to give me this one or not, LTCG or not. That's my question.
Sure. All right. Kaustubh, before we give him his answer, could you also, for the benefit of other users or other viewers, explain what exactly is this asset allocator fund of ICICI Pru?
Yeah, so this, the asset allocator fund of fund basically invests across various fixed income and equity funds of largely of ICICI, and typically it's like a 50-50 sort of, more balanced sort of portfolio. So, it's not equity heavy or fixed income heavy in that sense. And there's also a gold element, through the gold ETF that it invests in. So it invests across sort of asset classes, for the fund. And obviously it also picks some of the, themes that they find probably the ones that will work over the next, few years. So you would find some of those sort of thematic exposures built into that, expressing the view of the fund manager. So it's kind of doing the job of a portfolio construction for an investor across asset classes, and also kind of going underweight, overweight themes that they think would they can play tactically, rather than an investor doing that himself or herself, right? So that's kind of the broad construct of the fund. I think to the specific question that Mr. Malik had in terms of taxation, yes. Fund of funds, the taxation is what we call non-equity, or, it's a debt fund basically. So it will be taxed. Any capital gains will be taxed as per the tax slab of the investor. I know he's a retired person, so he'll need to figure out, because remember, it's only when you book the capital gains will you be
You'll be
paying the
taxed.
tax.
Yeah.
So you can always work it out accordingly. Each year if you're booking profits for use or whatever, it's not necessary that you'll get taxed because if you're
Got it.
retired and you don't have a regular income, then obviously you can probably not really end up paying any tax on it. But obviously it depends on every individual's tax
Sure,
situation.
sure. All right, and with that, it's time up. Thank you so much, Costa, for being on the show, helping our viewers with their financial portfolios. And before I sign off, I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. Thank you so much for watching. Goodbye.